Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome back to video 7 today, where we'll talk about sell put options. And you may have picked up on my tone of voice that selling options is one of my more favorite strategies. We talked about selling calls a couple of videos ago. Today we will talk about selling puts in the opposite direction. So let's get started. Here's the agenda we planned for you today. We will talk about why do we sell puts and what is an ideal scenario for us to pick as to which ones to sell puts against. Compare these naked puts with the naked calls. So give you an idea of what do I mean by opposite direction. Then again, we'll go shopping together on the 60 largest Toronto Stock Exchange stocks to see which one may be an ideal scenario to sell a put option against. And then you'll find it's very confusing to decipher the options chain, and that's where we will incorporate the options play tool, as well as recap all the free tools and talk a bit about mentorship programs available once you've graduated and passed all these recorded videos. So let's get started. So why do we sell puts? Well, my favorite reason, again, with all option contracts is it provides me with an asymmetrical reward to risk ratio. This then derives a much higher return on investment by percentage. And remember, when you buy options, it costs you money, but when you sell options, you collect money, and you collect it right up front. So one of the more conservative option strategies available. And it's always good to collect money up front. And no matter what happens to the stock, whether I'm right or wrong in my forecast, the premium I collected from the day one, I keep. So this is ideal when the markets are flat, especially bank stocks, which is one of the more stable industries out there, less volatility, and especially if there's upward pressure in price. Those are ideal scenarios where the movement are more predictable and it's easier to sell a put contract against. And also, any premiums I collect helps reduce my break-even points, even if the shares were exercised and I was forced to buy this premium asset at a discounted price, of which I determined because of the strike price and expiration is within my control. So we talked about naked calls, and how are naked puts different? Well, in both scenarios, you control your destiny. You determine the strike price, you determine the expiration date. And also both scenarios, once you've sold this obligation, you keep the premiums up front. And since we're not talking about any covered call scenarios, there is no requirement for you to own the shares at all. And because of that, your broker will have margin requirements that you must meet, and you need to check this requirement with your individual broker in your country. And once exercised, again, in the case of the naked call, you sold the right to somebody else to buy certain shares at the strike price and expiration date you determined. So you would have an obligation. If you did not own those shares in the covered call scenario, you would need to have cash flow to go out and buy the shares on the open market at the higher price to meet your strike price obligation. Or if you did not want to own the shares, you can always, prior to expiration, close out your position by buying the call option back from the open market and take a bit of a loss, but much less than having to use the cash flow to buy all the shares, because every contract is 100 shares. And flip side, on the other scenario, why I'm a big fan of put options. Imagine buying an asset instead of at a premium price, I'm buying it at a discounted price. So if one of my favorite blue chip bank stocks is trading at a price where it falls below my strike price, I'm actually not too concerned about buying a premium blue chip stock at a discount. And that's exactly what happens with a put option. So again, I must have cash flow ready to close out my position and honor my obligation if somebody exercises their put contract by forcing me to buy those shares at the strike price. Or if I still really don't want to own those shares whatsoever, then I would close out my position and take a bit of a loss on my put contract by buying it back on the open market. So there are risks associated with stock ownership. You actually control time. You can always wait for the stock to rebound, and we know all companies have cyclical cycles of ups and downs. And then you can sell your stocks again, whether it's a few weeks or a few months later. So for the put seller, and you in this case, you must be bullish on the stock. You cannot be selling put contracts against companies that are going down and down and down. Although at the money is when the premiums are the highest, but that's purely made up entirely of time premium, and it's also the greatest risk because you're already at the money. That has the highest chance of getting exercised. So typically you would want to exercise a strike price where you choose to be out of the money, a little bit out of the money to give you a bit more cushion, so that if the stock price falls a little bit further, it's still not touching your strike price. And what you're sacrificing is a little bit less premium, but you're gaining a higher probability of that contract expiring worthless, in which case you keep all the premium. So let's look at the scenario here. So naked puts, you do not need to own the shares. So do check with your brokers on the requirement for margin. And if it's $50 a share, then your strike price at 50 will be at the money, and let's say there's $2.50 in premium. If you actually sold a $54 contract, it's actually in the money by $4. So there will be a higher premium per share associated with that. And likewise, if the strike price was $46, that's a little bit out of the money, you would have to take less premium. So this allows you to select how much risk-reward ratio you would like to live with. Best case scenario is the stock price stays above the strike price. So in this case, stays above $50. Then there would be no reason for anyone to exercise their contract. And you would then keep the premium and be able to go back once it's expired, go sell another one. Worst case scenario, if the stock does fall below the strike price, then there is an incentive for the buyer to force you to buy those shares at the strike price, which would be higher than the market price. So in that case, you would need to go to the market to buy these shares from this exercise, even though knowing that it's actually a higher price than the market. Alternately, if you're monitoring your positions, and hopefully you are, you could close out your obligation before expiration and buy back the put option at a bit of a higher price and take a loss, but much less cash flow than being forced to buy the shares. So let's look at another scenario. This is a little bit more deeper into the analytics. So let's look at a scenario. If the price of the stock was on the high end, $54, but the strike price was 50, there would be no incentive for the put contract holder to force you to buy at $50 when he or she can get $54 per share on the open market. So in such a scenario, you keep the premium of $2.50 times 100 shares. So $2,500 you keep in your pocket, wait for expiration, go sell another one. If even it goes to $48 and you were forced to buy the shares at $50, you've taken a $2 loss, but you've taken $2.50 per share in premium. So your net gain, you're still ahead by 50 cents per share, which is $500. Your break-even point is actually at $47.50. And if you were really, really wrong, then your obligation is to buy these shares at $45 or even possibly $40, knowing the market price is $50. So those are scenarios where you either buy them at a heavy discount and now become stake owner in that company for the little bit longer term, or you could close out your position prior to expiration. So if the stock is at 50, Again, the strategy is you really don't want to be at the money. You want to sell an out of the money call option. The goal is to, just like the naked calls, you want to balance good premium received closer to the money but not at the money with risk and reward. And we will show you how to use options play to help determine these possibilities. So let's get started and shop for some candidates. We are looking for long-term rise, especially in the historical pattern if we can. We need to know a little bit about the fundamentals and the technical. We can't just rely on one or the other. And in this case, we're going to be looking for oversold signals, low RSIs, where it's reached a point where there were more sellers than buyers. So there's nowhere else to go but back up. And typically this is what we call the support level, because that's when bargain hunters will come back into the market. And our goal again is to set up our put option strike price so that the share price is unlikely to reach the strike price. We keep the money received, called the premium, and we move on and sell another one. And again, we're using Canadian equities as our examples. The list is much more focused with 60 stocks without taking too long for this video, but it's an excellent market to diversify from the Canadian dollars. It's a safe political climate. Most stable economy, often the strongest of the G7 nations. We have terrific bid-ask spreads on our own listed stocks compared to the same stock in the New York market. These are some of the more common names you may recognize. So let's get started. And again, on the right-hand side, you'll see the bubble pointing out the RSI. That's really where we're focusing our eyes on today. So first list is ABX, AEM. These are all fairly low RSIs at the moment. And let's just see now. This is a high one, 85. And you will come along one. The first one that actually is on my back of my mind is one called BMO. But here's Bombardier. ECH, BMO, Bank of Montreal had a nice one. And you can see this is literally like shopping at a shopping mall. And as long as you know what you're looking for and stay focused on what you're looking for, take your time, compare. Don't buy the first thing that pops into your screen. Lots to choose from. But what I'm looking for more specifically is not just a low RSI, but also something that hopefully has a long-term trend upwards in the stock price, so that I have some comfort and confidence knowing there really is a support level it will never break through. Otherwise, there are some stocks that are very volatile. They can hit new highs, new lows, making it very difficult for you to predict. And those will be more suitable to trade with a different strategy if that's what you wanted to do. But banks and financials are typically one of the more stable sectors out there in any country you go to. So for today's scenario, I think I know which one we would like to select based on what I saw earlier in the scan. We're almost down to the end of the list here. Here's another good one, TD. All these have downward price pressures. I don't really like any of these. So back to the top of the list. So I think today's exercise we will go with BMO, Bank of Montreal. Has a 47.33 RSI. Long-term trend is up and really has hit a new bottom, if you can see right here. Seems to have hit a new support level. So let's go to financial, another tool we told you about. And we're going to select BMO on the Toronto market and get some more additional support for our theory. And based on 3 years of analytics and patterns, it looks like it's on a long-term trend. So I'm feeling comfortable about this one. So let's log into my portal and we will look at the options change for this stock. So I will enter BMO. select Toronto Exchange, and you can see there's a long list of expiration. So first, which one do I choose? I really don't know yet. And even within each one, and I'll just randomly pick December 21, which strike price? Look at, there's so many to choose from. So even just a simple idea of selling puts, and again, calls on the left, puts on the right, makes it very difficult for me to try to decipher a strategy out of this phone book of numbers. So let's deploy options play and use that strategy. So put in BMO for Toronto. And it is trending a little bit bearish. The technical is 6. So long term is fairly flat and stable. I'm going to click on bearish. And I can see the support levels is 93, although it hasn't hit that number for a long time. So let's go to the income. And on the right, I will select the put option, selling a put, and it's automatically defaulted to a January 18, 2019 94 put with a 79% of expiring worthless. And the spread is pretty reasonable and suggesting a mid price of $1.05. So if I close this tab, and I'm going to modify and just take a look at some of the other relative scores. So expirations, I could toggle and play with all these other shorter and longer expirations and look at the percentages ranges from 99 down to 75%, 60%, 57%. And these are the percentages POW, probability of expiring worthless, and that's a good thing for me. So here I probably may choose not too long and a November 30th, and I will go with a shorter price, a lower price as well at 97, so $2 lower, 96.50. Now I got 81% chance. So I feel pretty good. 76.54% for a 2-week window for it to not hit $97. And now I'm looking at a 55 cents suggested ask price to enter my trade at. So November 30th, 97. And just one more time for our Asian viewers. Selected my bearish look with income, and instead of doing a covered call, I'm doing a put strategy. I will analyze the different expiration dates, and when you're selling, you really don't want to sell too long because there's a lot less probability of expiring worthless with less certainty the further out you go. So as long as you have a low fee brokerage account, you can sell a lot of short-term strategies. Probably is a little bit more manageable way to go. And again, $99 is too close to the money with only 59%, so I'm changing this as I go. 97, again, November 30th with 97, I have a 76% chance. So 3 to 1 are the odds in my favor. So this is what I've decided I will do. It's only 2 weeks out. So I'll go back here, I'm selecting November 30th. And I'm selecting 97. And once I enter this, I will change the buy to a sell. I am selling. One contract BMO, November 30th, $97 put. I look at the bid and ask, and actually I'm going to get a bit more greedy, and I want 57 cents. Just a little bit ahead of line, and I want to make sure it's good to close. Preview my order, and that's how I will put $57 in my pocket to sell something I don't even have. How great is that? So we talked about some of the free tools again. I've been using it all frequently, freestockcharts.com. Mac users can go to a different site to get something similar. One of my favorite tools is the Financial, who helps me to look at seasonal stock patterns based on last 3 years of statistical movements. And this is where you get the virtual account that I showed you. This is a fantastic site, TMX Money, for options chains on Canadian equities. And investing.com is a terrific site for American equities. TipRanks helps you give more analytical price estimates from different analysts in the market. FinViz, for you to drill down into earnings and a lot of more details about specific companies. And the colored map helps you look at these sectors on a daily basis by graphical color as opposed to confusing charts. And the Canadian Stock Exchange website for options, m-x.ca, is an excellent place to start. That's also where you can get your options play for free for Canadian equities. Also look at Option Matters, where you can get a lot of feedback from industry veterans on strategies and trends. And weekly podcasts from macrovoices.com are also free. And again, your options play for Canadian equities is free right from this link. So for US equities, all the strategies are the same. It's just you have a lot more broader choices to go with, and options play is free for the first month, available from any of these two sites in 2 languages. So I hope you enjoyed this video. Please continue your journey with us. We will have additional videos to follow. Learn, practice, repeat. Tell your friends about us. Everything we do is free. No credit cards are needed. Subscribe to our list online to keep updated with trade ideas and new video updates and so forth. And once you've graduated our video programs, you may consider trying a 7-day free trial to the online mentoring services, where you have a 2-way dialogue aimed to further your journey into your options trading experience. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat, and if you found it useful, please share it with your friends and family. See you in the next video.